I want to evaluate each of these 7 points between the dollar and the euro. Number one, gold price is rising. It's rising in dollar terms, it's rising in euro terms. And keep in mind, too, when I'm talking about the dollar, what is backing the euro? You know, you have a little bit of gold in the ECB if it hasn't been loaned out. We don't know how much has been loaned out because the ECB does not disclose that information. They book on their balance sheet gold in the vault and gold out on loan as one line item, defying generally accepted accounting principles in order to keep secret exactly how much gold they really have in the vault and how much gold has been put out on loan. So, you know, eliminating the gold from that, what else is backing the euro? The US dollar. If the US dollar goes into the black hole, the gravitational pull will eventually pull the euro with it. That's my basic premise. It might not happen right away. It might take a few weeks or a few months. But unless the euro creates its own policy separate and distinct from the US dollar, if the US dollar goes into the black hole, the gravitational pull will pull the euro with it. In any case, the gold price is rising in both currencies. Oil and commodity prices are rising in both currencies. It's rising a little bit faster in terms of the dollar rather than the euro because the euro has moved from 142, 140 up to about 150 against the US dollar, but they're still rising in euro terms as well. Negative real interest rates. What's true for the dollar is true for the euro. You can't get back at the end of the year enough interest income on your bank deposit to offset the loss of inflation and the counterparty risk that you're taking by keeping that deposit in the banking system. You're much better off holding physical metal and preserving your purchasing power without counterparty risk than putting those dollars on deposit in the banking system because of negative real interest rates. Again, it's the same in Europe as it is in the States. Blind faith in the ECB. Everybody seems to think the ECB is going to get it right. But as I said before, the ECB is not the Bundesbank, and they don't have the same responsibility to sound money that the people who managed the Bundesbank back in the 60s and 70s and even the 80s had to the commitment to sound money. ECB is looking for everybody. When they're trying to take care of everybody, they're not looking for anybody. And as a consequence, we as individuals, thank you. As a consequence, we as individuals have to take care of ourselves. And the way to do that is you cannot count on the central bank reserves. You have to count on your own gold reserves. Stock market is rising in Europe in the face of bad economic conditions. That's another indication that, you know, we have hyperinflation, rising stock market in the face of bad economic conditions. It's not as bad perhaps in Germany as it is in Spain. You know, you have 18% unemployment in Spain, and it's continuing to rise, but generally speaking, the economies of Europe are in pretty bad shape. Runaway government spending. I mean, you're bailing out banks here in Europe, just like you're bailing out banks in the United States. Budget deficits are getting worse. Whatever happened to that 3% control limit that governments were supposed to follow when they put the Maastricht Treaty together? There are 13 governments in the EU now that are well over that 3% limit. You know, like most things that come from politicians, yeah, they sound good, but when push comes to shove, there's no discipline on politicians to control spending. There's no discipline on central banks to control the number of dollars or the number of euros that are being created. That was the beauty of the gold standard. It was an external discipline that limited how much paper currency could be created, how much deposit currency could be created. In the absence of that external standard, too much currency is going to be created and you're going to have hyperinflation. So we're getting, you know, what's happening in the States is happening here in Europe. So let's get to number 7. As I mentioned before, demand for the currency is falling, but, you know, here we are. We have one item left, demand for the currency, demand for the euro. What's happening internationally is as the US dollar weakens, as people start to understand that policymakers in Washington are on the wrong track, as people understand that too many dollars are being created, the demand for the dollar is falling, and people, as a knee-jerk emotional reaction, are moving into euros, and that's keeping the demand for the euro relatively strong. But if you look at the euro logically, if you look at it from an analytical point of view, you have to scratch your head and say, gosh, why would I want euros? Why not hold something else, that something else being gold, which that table showed has preserved purchasing power very, very well. and you don't have the counterparty risk when you're, as you do when you're holding euros. But this is the last little link in the equation. You know, when the demand for the euro falls, when people start to sense that there are problems with the euro, different problems perhaps than there are with the US, but problems nonetheless, you're going to see more and more people moving into gold, which gets back to my very basic point at the beginning. We're in stage 2 of this bull market. More and more people are going to start understanding what's happening to currency and moving into the precious metals as a consequence.